So someone in my community asked me a question a couple of weeks ago. I think that we need to talk about, and I've been thinking about it a lot. He said specifically, fees stress him out, especially at the big firm that he's in. Fees inside his investment account. He stated that his accountant sent him to the firm originally, and he's not upset with anyone. And if he hadn't have gone to that advisor, he probably wouldn't be putting money in an account now. He would probably have put it off. But that told me something. It told me, since he was asking, that he didn't really understand his fee structure. If that's you too, this video is for you. We're going to talk all about fees, fee structure, what to expect, and at the end, I'm going to just give you a couple of examples about why it matters and what kind of difference it can make on your account. And here's a quick reality check before we get into something. The Federal Reserve data puts the median retirement account balance for people 55 to 64 at around 185,000. And for 65 to 75, it's around 200,000. That's the median. It's not the average. That's the middle of the pack. Half of the people have less and half have more, but that's a significant factor when you're looking at fees. They hit the smaller accounts the hardest. So for most people, whatever fee you're paying, it's coming directly out of that account balance. And that account balance is not unlimited. A percent here or there makes a real difference. So let's go through this. There are 5 common ways people invest. We're going to go through them one at a time, what it actually is, how you find what fee you're being charged, and what you should be getting for it. So let's look at type 1, commission-based full-service brokerage. This is a traditional model. You buy a mutual fund or an annuity or a stock through a full-service firm. This is what was going on 25, 30 years ago. Still goes on today, but it's nothing wrong. There's nothing bad about it. I don't want you to feel that there's inherently anything wrong with any of these fee structures, but there are expectations, and you should be aware of those. So the traditional commission-based, you pay for an investment, you pay for advice at the time, you're charged a fee at the time, depending upon what that investment is. Most mutual funds sold this way have what's called a sales load. It's an upfront percentage that you pay, often 3 to around 5%, depending upon the amount of money. And there are different share classes, and I don't want to get into all this. Just understand that mutual funds, loaded funds they are called, have a fee structure, and they're typically sold in a brokerage account. We'll call this type a brokerage fee. You come in, you pay a fee to buy a stock, an investment, a mutual fund, whatever it is. You pay a commission, just a commission, and that's it. Now, with mutual funds, though, are continuing fees called 12B1 fees. That's in that environment that you pay the ongoing 12B1 fee. It's like a maintenance fee. It's just like an insurance policy. When you have renewals, you renew an insurance policy, you pay ongoing renewal fees, things of that nature. Be aware, there are different types of shares. I don't want you to get caught up in all that, but just know that in a brokerage account, when you buy an investment, you pay a commission. It's the simplest form. And that's it. And as long as you hold that investment, if it's a stock, you pay that commission once. That's it. As long as you hold the investment. If it's a stock, if it's a mutual fund, it could have those ongoing fees. So just be aware of that. How to find what you're being charged, if you're being charged this way. Look at your trade confirmations. You know, those little things that either come to you in the mail that you tend to discard, like with the voting prospectuses that you may get in the mail. But look at an actual trade confirmation when you buy the fund or buy the investment. It'll come to you either digitally or in the mail. Look for the fund's own prospectus. If you bought Income Fund of America or some other American fund or Fidelity fund, whatever it is, look for those funds to see what the prospectus says about what fees are charged. Look on your statement itself. It usually won't show anything because it's not a separate transaction. It's inside the fund. It's inside the fund's performance. If you buy a stock, you'll see it on your trade confirmation. So just look at that. And if you see a fee there, that you're probably in a brokerage type relationship. If you don't see advisory fees every quarter on your investment statement, then you're most likely in a brokerage type. So let's talk about what you should be getting for it. Since you're not paying an ongoing advisory fee, you shouldn't be expecting ongoing advisory management. Not active. The honest deal here is that you're paying for a transaction and the advice at the moment you make it, not year-round relationship. So if you're paying this commission-style pricing but also being told you're getting comprehensive ongoing management, that's worth asking about. Let's move on to type 2, fee-based. This is an advisory account, full service. It's another common setup. It's more prevalent today. You've heard those firms on, without naming, we do better when you do better. Yeah, they sure do. They also do good when you do horrible. They leave that part out. Because when the market's dropping and falling, you're still paying that fee. Now, part of advisory is weathering these markets. And I am, again, not saying that any one fee structure is the right fee structure. I'm just saying know what you have and know what to expect. So this full service fee-based advisory account, instead of paying per transaction like we talked about with a brokerage account, you're paying an ongoing advisory fee, usually somewhere around 1%. I've seen less, I've seen more. And it usually is billed to you every quarter. Now, you may have to dig for this one. The brokerage firms seem to like to put this at the very end. So flip to the last page and you'll usually see it on the ending quarter, June, April, September, end of a quarter. But this fee happens in your account, regardless of buying and selling activity. None of that really matters. The fee hits your account. Also remember that those ongoing maintenance fees that I was talking about in a brokerage account with a mutual fund, those fees are typically refunded in this account because you're paying for advice. There is no ongoing maintenance fee. So you're paying for the advice every quarter in these account structures. That 12B1 fee, we call it, that management or advisory ongoing fee is refunded to you inside the fund. You won't see it hit your account statement. It'll be inside the fund. What you should be getting in this advisory relationship. You are paying for ongoing advisory advice activity. The honest expectation is an ongoing relationship, periodic rebalancing, real conversations about your goals, and more than once a year. You should expect help around required minimum distributions. You should expect some tax planning and conversation to be injected at some point. You should expect someone to notice if your situation changes. But if the only thing that happens all year is one review call, that's worth a direct conversation with your advisor about the level of fees and matching the level of service. That's just a conversation. A good advisor will not get upset about that. You need to have the conversations and understand your fee structure. Let's move to type 3. This is the DIY. This is for all of you DIY guys. Hey, there's nothing to it. And there's not a lot to it. Most of what we do is hand-holding. It's talking you back from the ledge when the markets are bad. It's helping you understand that it's time in the market and not timing the market. It's helping you navigate real life. It's helping you work with tax advisors, estate planners. So, DIY, type 3, do it yourself. You shouldn't expect anything. It's opening your own account with a discount brokerage of Fidelity, a Schwab, something like that, an E-Trade. Picking your own investments. Often they're just index funds, and there's absolutely nothing wrong with that. That's the some of the best way to invest money is just flat out index fund with good asset allocation, good rebalancing. There's usually no advisory fee at all. I'm not familiar with every platform. Some may charge a little fee for once a year telephone call or so. I don't know. But generally, there's no advisory fee, no ongoing quarterly fee. The only real cost is the expense ratio built into whatever investment you buy, if there is one. It could be mutual funds. It could be exchange-traded funds. It could be whatever it is. But just look at the individual investment regarding the fees. And that's it. Some of these fees, they range anywhere from hundreds of a percent to a fraction to a 0.5%, but they will be plainly disclosed. Look at the fund's expense ratio directly. It's published. There's no digging. Just go find the investment and look at those. And that's it. There's no advisory fees. There's no advisor. You're on your own. What you should be getting is nothing beyond the platform itself. You're not paying for advice. You shouldn't expect any. You shouldn't expect to be quietly charged if you were getting some. This is the right fit for someone who's comfortable managing it themselves, or gets advice from outside certified financial planners, things like that, and then they do their own work. So they pay for this advice. And this is becoming more common. I've noticed this where people just want to get advice one time and pay for the advice one time. They're stuck on something, they need help. Boom, that's perfect. You pay for the advice, you get the advice, and you move on, and you handle your own investments within your account. Let's talk about type 4, Robo-advisors. This has been going on for a time inside brokerage houses. But this is just an automated platform that builds and rebalances a portfolio based on a questionnaire. Same questionnaire your advisor should be asking you. There's no human advisor involved. Cost is usually around 1/4 to 0.5% a year. It's automated and disclosed clearly up front. A couple of the bigger platforms I've seen out there even offer a stripped down tier with no advisory fee at all. So how you find it, you will know if you're in a robo type environment. It's always stated plainly on the platform itself. And it's the most transparent by the 5 by design. What you should be getting for this, what you should be receiving is automatic rebalancing, sometimes even automatic tax loss harvesting. What you miss sometimes is the automatic tax gain harvesting. I have clients who come into my office who are well down in the 0% capital gains rate sometimes. We can take gains. That's a question. It's not just about harvesting losses. Sometimes we take gains because it's effectively at 0% or very low percent. But what you're not going to get, you're not getting a person that's going to talk you through down markets, scary markets. If you watch the news, it's sensationalism, and that's what you're not going to get on this channel. We walk through the reality, no BS. This is what it is. I'm not selling you sensationalism, but you watch the news and it's a struggle to stay in the market, and you've got to. You can't time it. You're not going to get a person to talk about Social Security timing, maybe. You're not going to get a person that handles every scenario out there on this particular model. It's simply a robo model. It's a good fit for a fairly straightforward situation. It's not a substitute for planning. So when your situation gets more complicated, consider hiring a CFP, someone like that, certified financial planner. And I'm not one. I'm a CPA. I'm a investment advisor, but I'm not a CFP. And this is not investment advice. You need to either know how to do it yourself. If you don't want to pay a fee, research it and do it. If you do want to pay a fee, it's often well spent. Just find you a good advisor. It's not a big deal. Type 5, annuities and insurance, wrapped products. This is one where fees are hardest to see because of the cost. It's not deducted from your balance the way others are. It's built into the product itself. A variable annuity commonly stacks a mortality and an expense ratio charge, M&E charge, often a little over 1%, plus the expense ratio of the underlying sub-accounts, often close to 1%. And then if you talk about additional riders that go on top of that annuity, like a guaranteed income rider or a death benefit, those add up. You're looking at fees sometimes north of 3%. And what happens is that fee is not deducted from your account, but it's a deferred sales charge. If you withdraw the money too soon, you'll pay the fee. And it's graduated down 5, 6% the first year, 4%, 3%, so forth. And that's called a surrender charge. On top of that, the person who sold it to you was likely paid a commission by the insurance company. And that's not a bad thing. Again, some of these annuity products fit the right person. I was staunchly against annuities because of the fees initially when I first started managing money. However, I found that annuities give people who are extremely risk averse an additional layer of feeling protected, especially if you pick a quality, top-rated annuity company. You'll get a guaranteed income. You'll get a guaranteed return. It evens out the volatility of markets typically. Whatever the rider, particular comfort level may be, you have an additional contract with an insurance company. It's not to say they don't go bankrupt and that you don't get pennies on the dollar. Don't misunderstand me, because I've seen that happen. But it generally gives people who are averse to risk, want no part of the market, who are 58 years old and retiring with $2 million or $1 million, telling me they want to live on $75,000 a year, but they don't want to invest their money in the stock market because it's too risky. You can't do it. It's not possible. So sometimes you can structure in annuities to add that additional guarantee or additional layer of protection. That makes a client rest easier, and it enables them to stay in the market where I know they need to be. They need to be in the market, not watching the news all day, every day, wanting to get out one week and in one week. You can't make that happen. So how do you find this? You'll know if you're in an annuity. It'll be in the annuity contract, the paperwork when you signed up. All the fee schedule should be there. You won't see it on your statement alone. What you should be getting: guaranteed income stream, guaranteed death benefit, whatever it is that attracted you to that annuity, that's what you should be getting from that insurance company. And again, these are worth it for the right person. It's not a low-cost way, but it's a way to be invested in the market with an added layer of protection. But either way, the question underneath all of this is the same one my community member was really asking. It's not, are fees evil, but do I understand what I'm paying for? And am I getting what I'm supposed to be paying for? That's a completely fair question, and something you should approach your advisor and ask directly. Any good advisor will welcome that question, sit down and explain it. Now let's make it all concrete. What does it cost? What is the long-term cost? Let's use an illustration of an investor take $100,000 growing at 4% for 20 years. Nothing changes except the fee. At 1/4% that account grows to about $208,000 over 20 years. You pay about $7,200 in fees. Is it reasonable? Ask yourself that. The advice that you're getting, is that reasonable? At 1%, though, same starting balance. Now the accounts grows to only $180,611. $180,000 versus $208,000. That's a $26,000 gap. Now ask yourself, is that reasonable? Am I getting what I'm paying for? Nothing went wrong with the investments in either case. It's the same return. Only difference is the fee. Now scale that up, though. $500,000 rollover. Long return of 7%. 25 years, let's say. Comparing a full service advisory fee about 1.25% against a low cost 0.25% alternative. The gap by year 25, $536,000. Same lesson, bigger number. Retirement accounts often run longer than 20 years. And here's the part that matters most. If you end up managing money yourself, paying more doesn't typically buy better performance. The S&P's own tracks actively managed funds against their benchmark index every year. Over 20 years ending in 2025, 79% of large cap U.S. stock fund managers, these are mutual funds, underperformed the S&P 500. Over periods of 15 years or longer, there wasn't even a single major fund category where most active managers beat that benchmark. That's not a knock on anyone's personal stock picking. It's just genuinely hard to beat a low-cost index consistently enough, decade after decade, to make up that difference in fee. None of this means you have to hire anyone, and it doesn't mean picking individual stocks either. If you want to manage your own money, the research points to a pretty simple approach. Broad, low-cost index funds instead of individual stocks or high-fee actively managed funds. A stock-to-bond mix that actually matches your age and your risk aversion. How much risk you can stomach. How much volatility you can stomach. If these numbers, if these terms that I'm using don't make sense, you either need to educate yourself on them or don't manage your money yourself. It's that simple. Get some advice somewhere. A stock-to-bond mix, too, that actually matches your age. Not just the hottest new stock you heard about, but rebalancing back to the mix once you get out of balance, once or twice a year. I say once a year, not every time the market moves, and leaving it alone in between, because the data is pretty consistent that investors hurt themselves more by reacting to headlines than by any specific fund they pick. If managing several funds and rebalancing feels more like you, and you want to take that on, do it. If it doesn't feel like you, maybe a single target date fund. These are popular. They hold a mix of assets already, and they're based on a target retirement date. It's a completely legitimate do-it-yourself answer. It's how a lot of workplace retirement plans work right now by default. Even if you manage your own investments, in the planning and tax side, when do I pull money from which account? How to handle required minimum distributions. Does a Roth conversion make sense in any given year? Not just this year, but what about the next years? There's a different skill set involved there than picking investments. And I think that's what many people tend to overlook if you're getting quality advice. There's a whole level of skill set there, plus usually the experience of the advisor. But given that skill set, if it's not for someone like you, then pick an advisor, someone who's recommended to you, discuss the fees, and discuss the level of service. Here's what I'd tell my own family. I want to be really clear about something. I'm not talking about firing anyone. Don't go out and fire your advisor. Plenty of people are paying a fee-based advisory percentage, and they're getting exactly what they should be for it. A real planning, real attention, someone who picks up the phone, and plenty of people are doing that now. And a lot of people have gotten into investments into a SEP account or a Roth account years ago because someone, a CPA, an insurance agent, an attorney, put them in front of the paperwork, and it got them started. Otherwise, they wouldn't have a dime today. So there's value in different things. My point is you should feel the value. And if you don't, it's time to reevaluate, have a talk with advisors, maybe get an outside opinion. That's worth something. And the goal isn't suspicion. It's just making sure you're not in the dark about your own money. Know what you're paying. That advice is supposed to cost you. And if there's a gap between those things, that's a conversation to have, not a reason to panic. So if you want help actually pinning down your own number, what you're actually paying across whatever account you got, that's exactly what my community is for. Right now, it's free to join. The first few members, I'm just building this. Depending upon when you see this video, it may or may not be. But we're building a community of members who want to talk through these type things and make better financial decisions for themselves, or at least shed some light on their own financial activity, their own financial world. So go to my community. The link's in the description. Subscribe here and do all that stuff. But again, thanks for watching. I appreciate it. I'll see you next time.